Equities are also referred to as stocks and shares. For the sake of our studies, we'll use them as interchangeable terms. When you buy a share, you're taking ownership of a small part of a particular company. If the company declares them, you receive dividends as a result.
What is a dividend?
Good question. The purpose of a company is to make a profit for its shareholders. The dividend is the way a company pays out its profits to shareholders. Think of a dividend as a financial reward for taking the risk of owning a share.
Is that the only way I can make money from owning company shares?
No. All public companies have a quoted share price. This is the cost to you to buy one share. If you own a share and the price goes up, when you sell, you will make a profit. In order to explain how stock trading works, we'll use a simple example. British Petroleum plc, or BP as it's more commonly known, is a huge oil company with about 20 billion shares. Let's say each share is currently worth £5. This gives a company an equity value or market capitalization of £100 billion. Now, let's say that you think the value of the company will go up and you buy 100 shares for £500 in total. Well, congratulations, you are the proud owner of a 0.0000005% of the company. And say that a month later, the share price has gone up to £5.50. This means that the total equity value has gone up to £110 billion and your portion to £550. You sell 100 shares and taxes and commission aside, you have made £50.
Well, this sounds fairly straightforward. But share prices don't always go up, do they? What happens if they go down?
That's right. Share prices can go down as well as up. If BP's share price had gone down to £4.50 and you had sold, you would have lost £50. For that reason, it's incredibly important to analyze the company you're trading. We'll cover the different types of analysis later in this course.
Understood.
That just about wraps up our example on shares. Next up, we are discussing indices. Indices are part of the equities asset class. They play a hugely important role in global finance, with the FTSE and Dow Jones being the most talked about. An index is simply a single measurement of the price performance of a group of company shares from a particular exchange. Its main job is to use a consistent method of measuring those shares.
I've heard a lot about the FTSE 100. What exactly does it mean?
The FTSE part was just the result of good foresight by a marketing team at the Financial Times back in the 80s. They teamed up with the London Stock Exchange to create an index called the Financial Times Stock Exchange. The 100 bit means it represents the 100 largest company shares traded on the London Stock Exchange. If those shares increase in price, the FTSE 100 goes up. If those stocks decrease in price, the FTSE 100 goes down. And you have one simple number that tells you what's going on. Reporters like simple numbers.
This all sounds rather simple.
It's a little bit more complicated than that, though. How are these indices actually calculated?
Indices are typically calculated in one of two ways. The majority of global indices, FTSE 100 included, are capitalization weighted. This means that a company with a higher market capitalization has a greater impact on the index's price.
Market capitalisation is the total value of a company's shares, right?
Yes, exactly.
But I don't understand why it would have a greater impact.
No problem. Instead of using the top 100 shares in the UK, for the sake of this example, let's look at just the top 5. You might have heard of some of these companies. Royal Dutch Shell is the largest company in the index and has a market capitalization of around £185 billion. It accounts for about 29% of total value of our mini index. If the price of Royal Dutch Shell Company shares increase by 10%, it will add £19 billion to its market capitalization. The total for the index will now be £659 billion, an increase of 2.9% from the previous total of £640 billion.
But why is it greater? It doesn't make sense.
Let's start again and see what happens if a smaller company, British American Tobacco, were to increase its value by 10%. Its value would increase by £10.2 billion, which would mean the total market cap for the index only increases 1.6%. This is why bigger companies have more of an impact on capitalization weighted index. Of course, there are a few more calculations required to get from the total market cap to the single index price that you see on TV and quoted by brokers. But for now, that's essentially all you need to understand.
Oh, I get it now. Thanks. You said that there's another way that stock indices are calculated.
Yes, some major indices like the Dow Jones and Nikkei are price weighted. This means the companies with a higher share price affect the index price more when it's price weighted. In our previous example, a 10% increase in the Shell price would increase a price weighted index by 1.5%, and a 10% increase in the British American Tobacco price would increase it by 3.8%. A significant difference from a capitalization weighting.
That makes sense.
Good. That wraps up equities. Now let's talk about foreign exchange.